Welcome back, everyone. Happy Sunday. It's Colby, the DGI Crab, coming at you with the weekly undervalued stocks list, where we go over each of the four tiers. That's right, the 60 stocks this channel focuses on, broken down into four smaller subsections or tiers based off of the age of the investor. The Once Friday series now has moved to Sunday. Hope that you all have gotten the memo on that by now. This is the second Sunday that I've done this one on this particular day, and that's exactly what I'm going to do moving forward. So, hope you're all having a great weekend so far. Now it's time to put together a little bit of a plan, if you will, knowing what looks undervalued going into the week and what you might be setting your sights on as you are looking to add to your pile of passive income. And just this past week, I did a small initiation of a position into another stock in the DGI Crab channel portfolio. And I'll show you exactly which one that is as we get further along in the video. Now, I will say I'm not a licensed professional advisor. You should consider this channel for entertainment purposes primarily. These opinions expressed are just this one crab's opinion, and you should always perform your own due diligence before you invest in any security. And real quick, for the newbies out there, if this is your first time here, my personal investment strategy is as follows. Now, I'll do 50% of new investment dollars into age-appropriate ETFs for automatic diversification. And I'm looking, when it comes to single stocks, for stocks that are yielding at least 30% or more above their 4-year average yield. My top 10 favorite stocks, which are just my personal preference, those only have to hit the 20% or more undervalued mark before I will go ahead and add them. They're the bluest of the blue chip of companies as far as I'm concerned. So I'm not looking for a huge discount on those because they don't often go on sale to that particular level. Now, I'm going to remain within my personal age tier unless there is a stock in a different tier that's yielding at least 50% more than their 4-year average yield. And that is exactly the type of stock that I added to the DGI Crab portfolio, one outside of my own age range tier that was at least 50% on sale. Then finally, if within my own age tier, there's just not anything that looks like it's a particular good value at the time, I don't invest less for the week. I still stick to my per dollar per week strategy, but I'll just put more money into ETFs. I'll do an ETF double down, so that way I continue to add to that passive income, even if there's not an individual single stock that looks like it's a good deal at that particular time. So now as we take a look at the spreadsheet, what we're going to be looking for here is the valuation tab. I'm getting this metric by comparing the 4-year average yield of the stock compared to the current day yield, and then getting the valuation metric for how undervalued it is based on those two numbers. If it's in green, we've hit that 30% or more undervalued, and then anything else that's not in that green are just hold stocks for me. I just hold on to them. Whatever position I have, I let all dividends reinvest so I can continue to gradually grow that position, but all new money goes into things that are in that green, that 30% or more undervalued. And what we're looking at here is the tier 1 category of stocks. This is for the 18 to 30-year-old investor, where we're looking for not super high starting yield, usually between 1 and 2%. But we're looking for a cumulative annual dividend growth rate well above 10%, because this group of investors has a lot of time in the market to let those super compounders really create a strong dividend investment snowball. Nike and Nordson, once again, are the two stocks that are in that particular buy zone. Nordson is starting to show some signs of recovery, I think. We'll just have to see how that comes along. And the longer Nike stays down here in the low 70s, the more that 4-year average yield will continue to creep up. I update this every single week, so we've got the most up-to-date 4-year average yield week in and week out. Nike, when it initially dropped late in the summer of last year, when it dropped from the $90 to $100 range down into the 70s, the 4-year average yield was 1.04%. Now, after being down for about 6 months, that 4-year average yield has climbed all the way up to 1.19. So again, the longer it's down here and this 2% plus yield remains the norm as opposed to an aberration over the course of a 4-year stretch, then this valuation will look less and less appealing. But for now, I think it's still a time to just continue to add to the Nike position. We're going to hope that they come out of this rough patch on the other side looking okay. Tier 2, the 31 to 41-year-old investors. At age 41, I'm in the final year of being a Tier 2 investor. The starting yield for this group of stocks is going to be a little bit higher, looking more in that 2 to 3% range, with a annual dividend growth rate in the high single digits. We're wanting like 7 to 9% dividend growth year over year out of this group of stocks. We've got a nice solid group of 4 that are in the undervalued range right now. Hershey, Target, NextEra Energy, and American States Water. NextEra Energy did a 10% dividend increase this past week. I'm quite excited about that. It was just on the outside looking in terms of being undervalued, and then we got that nice dividend increase going from 206 per share per year up to 226, 226 and a half, something like that. And that put it firmly in that green zone. I missed my buying opportunity on that this past week, but so long as it stays down here below $70 a share, I definitely see myself adding to my NextEra Energy position next week. Hershey, Target, American States Water, they were all in that buy zone last week as well. Still really like all 3 of them at these particular prices. And American States Water is yielding 2.5%, but the other 3 you're yielding well above 3%. So a good solid starting yield on these. And just by the way, Nike in the tier 1 and Hershey in the tier 2, 50% or more undervalued. So these could be open season for any of the age tiers based on their prices right now. Tier 3, the 42 to 53-year-old investor, looking for 3 to 4% starting yield here. That starting yield we want to purchase getting a little bit higher as we get a little bit older. Starting yield, we're probably looking anywhere from 5 to 7% cumulatively on the dividend growth. Archer Daniels Midland and Hormel, both 50% or more undervalued. Archer Daniels Midland and Hormel have been the top 2 cheapest stocks in this age tier for months now, even though their 4-year average dividend yield continues to go up a basis point or 2 week in and week out. They still continue to look very undervalued, both yielding above 4%. Really surprised by both of them. Archer Daniels Midland did a small dividend increase within the last couple of weeks. Certainly wasn't anything too exciting, just a 2%er, but they did do an 11% increase the year before. So 11% in 24, 2% in 25. That averages out to 6.5% over a 2-year period. Still not too bad when you're getting something yielding well above 4% to start out. I still have plenty of faith in Archer Daniels Midland to right the ship here. And then Pepsi, one of my top 10 favorite stocks. That is one of the ones on my list. Very much still in the buy zone. I'm still adding Pepsi at these particular prices. Genuine Parts Company recovered a little bit. Last week they were down in the mid 110s. Now they've gotten back up to 124. I'm going to hit the pause button on that one for just a little bit. Still not a terrible deal, but so long as there are better deals than that, I'm going to keep my focus on the ones that are in that green zone if I'm in tier 3. So a total of 4 stocks now in that 50% or more undervalued. Nike, Hershey, Archer Daniels Midland, Hormel Foods. And then finally, tier 4 for the age 54 and older investors. Now, I'm going to be a stickler on this one still. You know, if you're still adding with your active income to your dividend portfolio to give you more passive income in order to retire off of, if you haven't reached that point of financial freedom yet, at this age in particular, no reason to really get risky on individual single stocks. I love all 10 of these stocks, but I am absolutely going to wait for any of them to get into that 30% under or more undervalued range before I buy any of those. Tier 4 investors, you're still looking at ETF double down. So the strategy for the week is as follows, as I always will point out, 50% or more goes into ETFs. So that way you're well diversified. If one of your individual single stocks doesn't end up working out for you, it's not the end of the world. You could always sell out of the position at some point if there's a dividend cut or there's some other compelling reason to move on from that stock. You've got plenty of diversification with the ETFs. Tier 1, my primary emphasis is the S&P 500 with some small cap value getting peppered in there as well. Tier 2, dividend appreciation. The aggressive dividend growth of VIG is very appealing for that 31 to 41-year-old investor. Tier 3, the 42 to 53-year-old investor ought to be looking at something like SCHD or VYM as a slightly higher starting yield, but still solid dividend growth play for them. And then for tier 4, I do still like SPYD for just the pure stock exposure to the large cap stocks. But then you're also probably going to want to pepper in some other things for additional diversification that all offer high yield and for the most part monthly payers, high yield bonds, preferred shares, MLPs, covered call ETFs, Devo, JEPQ, and SPY I think are a great trio of covered call style ETFs. And then I do VYMI across the board, young through old, as my only non-US stock allocation. I really like VYMI for non-US stocks. And then for that tier 1 group, I'd be allocating it kind of like this. I'm going to put my largest chunk into Nike, the most undervalued stock in my tier, and then Nordson. Then for the remainder, I'm going to put a nice 10% chunk into Pepsi, top 10 favorite stock, very undervalued. Might as well start building that position. And then Hershey, ADM, and Hormel, all in that 50% or more undervalued in tiers outside of my own. I could probably reach up and grab a little bit of each of those and start building small positions in those companies, even at a young age. Going to give the green light to younger investors here to grab some higher yield stuff, because if the share price is way down and we think there's a recovery story over the long haul, it's also not a bad growth play potentially. That's kind of how I look at it. Now for the tier 2, Hershey is going to be my biggest emphasis here, the most undervalued stock in tier 2. And I am going to add Target and AWR here, as well as Pepsi, Nike, ADM, and Hormel. NextEra is in that category as well, but I didn't notice the dividend increase until later in the week, so I'd probably do 10% Nike, so I instead of 15, so I've got an extra 5 left over to put into NextEra Energy, just kind of as a side note there. And then for tier 3, Pepsi is going to be my primary focus. I'm going to really go hard into Pepsi if I'm in tier 3. And definitely I'll still be adding to ADM and Hormel within my own tier, and Hershey and Nike within the other tiers. And then for tier 4, since I'm going to be doing an ETF double down in tier 4, I'm going to do that with everything but VYMI, which means that between all of this, I've got 95% of the money for the week invested. With that extra 5%, I think I'm going to keep hitting Pepsi in the tier 4 category as well. You could do ADM because it's getting nearly 4.5% yield. Maybe that's more appealing, but I still would prefer Pepsi even over ADM at this point in time. And then the DGI Crab channel portfolio, as I said, I've got a new position here. I did do a small $5 add into Hormel. It's the first time it's been 50% or more undervalued. I'm not in tier 3 yet, but I did reach up there and just do an initial $5 hit into Hormel just to get the ball rolling there. And let's see, not anything too interesting here. Just like I said, doing 100 a week consistently into this one. So I thought I'd let you guys see how that kind of how that broke down, how many dividends it's paid out, and what the projected annual income is. All right, everybody, that's the video for the week. I will see you next time.